Medline has filed for an IPO, and it could be the largest deal of the year. We'll look at S-1 highlights. In IPO Radar news, Ripple raises a massive round. OpenAI's CFO throws cold water on the potential IPO, and Anthropic projects an insane amount of revenue. Welcome to the Access IPOs podcast, where we explore opportunities to invest in the world's most innovative and disruptive pre-IPO companies. I'm Craig Stevens, founder of Access IPOs, and this show is more than about IPOs. It's about access. And as we head into the end of the year and IPO volume slows, I'm going to be talking more about this idea of access for ordinary investors. We know that if you're a wealthy person, if you're an accredited investor, you have a lot more options than everyone else. And even if you are accredited, that doesn't mean you can afford the minimums to invest in some of the great companies of our time. Private companies are staying private longer. And while access has improved for everyone, including non-accredited investors with some of the venture capital funds out there, there's still this gap between equity crowdfunding, which provides some access for ordinary investors to invest in very early stage companies through the crowdfunding laws that were passed back in 2012, to the IPO stage, when ordinary investors, non-accredited investors, can start investing in companies that are going public. And that middle stage, that early stage venture capital through late stage venture capital, through overextending their stay in venture capital phase, that is largely not accessible for the vast majority of investors. Unfortunately, that's where the most growth happens. We've seen XAI go from $1 billion company to a $200 billion company within a few years. OpenAI was a $28 billion company just a few years ago, and now it's a $500 billion company. SpaceX has grown to a $500 billion company in the last 10 years. Anthropic is now a $200 billion company. Databricks, $100 billion. So all this growth is happening in this phase where retail investors, most retail investors, just don't have access. There are several companies that are trying to address this and offering some access to pre-IPO shares through some of these platforms where investors can invest, but that's largely for accredited investors, and beyond accredited, being wealthy that can afford the large minimums. And now we see companies like Morgan Stanley and Charles Schwab swooping in and taking over Equity, Zen, and Forge Global. Those are some news stories that hit in the last few days. So we know that Morgan Stanley is not doing that to help their retail customers at E-Trade. That's going to help their private wealth business. Same with Charles Schwab. They're not doing that for retail. They're doing that for their wealthy customers. Now we know Robinhood is working on a solution, this venture ETF that I talked about a few weeks ago. And there's talk about tokenization, and certainly Robinhood and others want to take part in that. But the real issue is the regulatory framework. The regulations aren't moving fast enough to keep up with the technology, and much of the securities law is decades old. So the public markets do a great job, a very efficient job of giving access to everyone. It's fair, it's efficient, and you can do it from your phone. But private companies don't want to go there. The status quo isn't in a place where these private companies are incentivized to go public. So we saw a government official come out and talk about this, how they want to get more companies to IPO, and I totally agree, and that's going to probably be the topic of next week's show. But what's happening sort of inadvertently is that the SEC is protecting investors. They're supposed to be protecting investors by making it harder for companies to go public. But now we see private companies and companies trying to make it easier to invest in private companies where there's going to be less protections. All the while, these prediction markets are exploding, and the regulation framework for gambling has become much easier and much looser, especially with sports gambling and these prediction markets like Kalshi and Polymarket. And so I fear that people who want to be investing are actually going to go out and be gambling. These prediction markets can put things out there like, oh, I think SpaceX is going to be worth $600 billion within 1 year. And it's gambling. It's not investing in SpaceX for that to happen. And so these prediction markets open up a whole new can of worms for anti-investor protections, just like we've seen with crypto and these coins and NFTs. So, it's funny to hear the government talk about investor protections, but then the government also allowing all these other things that make it easy for investors to lose money. So as we close out 2025, look for more topics around access versus IPO, since we're going to probably see an IPO lull. And there's a few stragglers out there. And hopefully we get this Medline IPO, which I'll be talking about here shortly. But for the most part, IPO volume has dried up, and we're looking forward to 2026. In the meantime, I'll be going back to this really core topic, which is access. And access comes before IPO. We want to invest in the world's greatest companies, whether they're public or not. Ideally, they'd be public because that is an efficient way for us to invest in them, but that's not happening. So if you're an investor who wants to invest in great founders, great business models, and companies with a proven track record versus betting on the outcome of something in the future, I think you're going to like some of the episodes I have in store for the next few weeks. Today's topic is the Medline IPO, which we weren't even sure if this was going to happen, and we're still not sure it's going to happen because Medline has filed for an IPO, but they haven't updated their terms and started their retail roadshow yet. So once they update terms or amend their terms, there's a 20-day countdown, going back to that 20-day rule that I talked about a few weeks ago, that the SEC opened this up as an opportunity to go public while the government is shut down. I'm recording this Thursday, November 6th. If Medline wants to go public before Thanksgiving, looking at the calendar, they really need to get this filing amended today or tomorrow, Thursday or Friday of this week, and that may even be too late. That would get them a chance to IPO before Thanksgiving. Now, a source told me that Medline was aiming for a pre-Thanksgiving IPO. That was before the shutdown. There's nothing stopping them from waiting until December to do this IPO, and so there is definitely time to get the deal done this year. And the fact that they've filed is a sign that they plan to move forward. But if the government reopens, that's going to open up a new scenario for them. They may have to deal with some of the feedback that the SEC gives before they can go public. And so if I'm a private company thinking about going public in 2025, I'm going to say no thanks and just wait until 2026 until this shutdown is done. So we'll see what Medline does. We're going to focus on this filing today. So what is Medline? Medline is a medical and healthcare products and logistics company. It manufactures and distributes about 190,000 products that it makes on its own. These are surgical and medical products. It also distributes another 150,000 products from third-party companies that produce these things. These are things like surgical equipment and masks and hospital clothing and all kinds of supplies that we really only see when we're in the hospital or a loved one is in the hospital, or you might see it in the doctor's office or nursing homes. Medline competes with giants, Cardinal Health, McKesson, Owens & Minor. Cardinal Health has had a real run in its stock, so I think Medline maybe sees that as an opportunity to go public now. This was a company founded in 1966. It was briefly public in the 70s, but became fully family-owned later in the 70s. 2023, 24, some private equity firms took over. Carlyle, Hellman & Friedman, and Blackstone. Reports that Medline is going to try to raise $5 billion at about a $50 billion valuation. Now, before I step through this S-1, and it's not going to be a deep dive, I'm just going to take a look at a few highlights, but this is a private equity IPO versus a venture-backed IPO. Most of the companies that come across my desk that are under the IPO Radar universe are venture-backed startups. That means that venture capital companies take an early bet in these startups and they grow and mature to the point where they're going to IPO. Private equity firms own more established businesses, and in this case, they took over a 50, 60-year-old business from the family ownership and helped them get it to the point where it's ready to IPO. And so private equity is a little bit different. We don't see as many of these, or at least we don't hear as much about them. And there's some other companies out there that are private equity owned that could go public. Panera Bread comes to mind as a potential IPO that's privately owned. So at a $50 billion valuation, Medline could be a monster for this year. And it's good to maybe end the year on a high note, assuming we get fair pricing and there's demand for shares. The last few IPOs, Navan, Beta Technologies, haven't really done all that well out of the gates. And so the excitement that was early in the year when we saw Circle and CoreWeave and some of the bigger IPOs of the year sort of fizzled into September when we had that IPO week. Remember, the second week of September was really exciting. None of those IPOs really blew anybody away. And IPO investors might be getting skeptical. Like, why bother investing in these if I'm going to get stuck with shares that are sort of flat? So Medline is our last chance to end 2025 on a high note and go into the next year with some excitement and companies who are willing to move forward with their IPO to get more public companies into our index funds and give investors a chance to invest in growth companies instead of just the venture capital firms. Let's take a look at the S-1 filing. We're looking at the S-1 filing, and when I walk through these documents, I take a very high-level view. I don't do deep dives, at least not on the podcast. It'd be a little bit boring, but I do like to point out the things that are interesting to me, and I think that that investors should look at a minimum. Now, you might notice that these documents are at least 300 pages long, and maybe the SEC could look at reducing that burden on companies, and maybe that would help get more companies to IPO. I read somewhere that banks are writing these things with AI, and you can pretty much write like 90 to 95% of an S-1 filing with AI. Of course, the financials and all the audit work needs to happen separately. If investors don't need 300 pages of black text on white paper, maybe this is a bit overbearing and the SEC could lighten up a little bit on the requirements. That would help something. And we'll talk about that a little bit more next week. So looking at this S-1 filing, the first thing I always like to look at is the underwriters. Who are the underwriters of this deal? In the initial filing, we saw just the 4 names: Goldman Sachs, Morgan Stanley, B of A Securities, and JP Morgan. We've seen Goldman Sachs, Morgan Stanley, and JP Morgan on so many of these deals. In an amended filing, they added a whole slew of names. They're going to be joint book running managers. And so these are the companies that helped to distribute the shares. And being a $5 billion raise and a $50 billion deal, they're going to need a lot of hands out there to make this deal happen. Occasionally we'll see SoFi's name in here or Robinhood's name in here, and that'll tip us off to those platforms getting IPO access. Haven't seen that in this filing, but occasionally we'll see that. We usually see some sort of user-friendly pages in these filings, and it's an opportunity for the issuers to highlight something really important to them. With Medline, it's this: we make healthcare run better. It's a logistics and products company, and certainly that's important, delivering these materials to hospitals and facilities. But they have 33 manufacturing facilities, more than 300,000 products that they deliver, distribution centers, next day service, 95% of customers, 100 countries, and 43,000 employees worldwide. If you're a Medline employee and checking out this video and this podcast for the first time, welcome. We'd love to hear your thoughts, by the way. If you have anything you'd like to share in the comments, we'd love to hear your take on this deal, what it's been like over the past decade or so as a private company, what's happened during the private equity takeover, and now that the IPO is happening, we'd love to hear your take on this. This chart that is shared in the S-1 filing is the signature piece, I think, of the message they're trying to convey to potential investors. 50 plus years of consecutive annual net sales growth, 18% compound annual growth rate since inception. Inception, 1966. You can't even fit that on this chart. So going back to 1997, 30 years after the founding, they were well below $1 billion in 1997, hit $1 billion in annual sales in 2001, and $20 billion in sales in 2021. Probably got a COVID bump there. Looks like they were probably selling a few extra masks and a few extra supplies to the hospitals, but really extraordinary growth. And if you had to tell the story of this company in one chart, they've done a really, really good job here. This is not going to be the kind of company that you double your money in the IPO or you double your money every year. This is a long-term investment, and I think institutional investors will line up to buy this company. Pretty soon, this will get into the indexes and will be an institutional buy target because it's a solid, steady business. And this chart pretty much tells that story all in one here. Yes, we worry about profitability, but revenue and revenue growth is really a key factor, and they've done a great job here. There's a letter from the family, the Mills family, who's owned this for a long time. There's a letter from the current CEO that you can read over if you're going to invest in this deal. Mission statement, summary and mission statement, and overview of the business. Our mission is to make healthcare run better by delivering improved clinical, financial, and operational outcomes. Pretty boring company, right? But you can't just stand up a medical equipment or medical supply company and logistics company. You can't disrupt that industry very easily. But there's a really big network here of manufacturing facilities and logistics that have been in place for decades. And there's competition in this space, but this is a company with a foothold on their industry. There's that chart again, a little bit different look to it this time. Here's another image from the S-1 filing. Our integrated business model delivers the best value. And this force multiplier where you have the Medline branded products and the supply chain to deliver them. It's also evidence of the maturity of this business. You can't put together distribution centers and manufacturing facilities and a customer base and 95% deliverability in 24 hours. You can't put all that together overnight. This is a mature company with a mature business, and there are certainly investors out there attracted to that type of business. And here's a breakout of sales, 2024 net sales mix, supply chain solutions versus the Medline brand. So very even split here. The Medline brand, a bit more profitable than and the supply chain solutions. Talks about some of the products here: urology, textiles, skincare, respiratory, surgical gloves, minor procedure trays, vascular access trays, lab equipment. And so all kinds of stuff here is really essential to the healthcare system. We don't think about very frequently until you're there. I know when I'm in the hospital or the doctor's office and I'm waiting around for the doctor, I always like to look at the various things on the wall and the labels and who's manufacturing the equipment and who made that poster on the wall, like who's the one trying to sell you that drug. It's a fun way to kill time when you're waiting around in a medical facility. And I can't say that I see Medline a lot, or I've noticed it a lot, but I will be looking for it now that I know more about it. And their homepage on their website is kind of looking similar to the S1 filing. I think maybe they're probably getting an influx of investors going to their website. Some of the same numbers we see there: the surgical products, the employees, the next day shipping. Go over to the menu and the various products. There's anesthesia products and advanced wound care and apparel and beds and mattresses and central sterile diagnostics. Lots of very interesting pieces of medical equipment. This company has grown through acquisition over the years. They've acquired a lot of companies who have already produced products, and they've acquired them and brought them into their network. So it's a company that's been just very aggressive about their growth over time. Here's the anesthesia section. There's circuits, and I thought it was interesting, the apparel section, that there was underwear and bras and kids' gowns and the socks, all the stuff that people wear in a hospital that most of us don't see every day. But when you go to a hospital, either you have a loved one in the hospital or you're stuck there. There's a whole different style and fashion line of things to wear and products. So poke around this website if you want to learn more about the company. A lot of times when I'm researching startups that come under my IPO radar, I go to the website. I don't really know what they're talking about. They say AI this, AI that, automation. They start with all those buzzwords, and it takes a while to actually figure out what they do. Medline manufactures, sells, and distributes products in the medical world. So very easy business to understand. Looking at financials, the year ended 2024. Net sales of about $25.5 billion and net income about $1.2 billion. So this company's selling a lot of stuff and they're making some money. That net profit has increased over the last few years. In 2023, it was only $234 million. The year before that, it was a small loss. But looking at the revenue, year ended 2022, $21.5 billion. 2023, about $23 billion. And in 2024, the year ended December 31st, $25.5 billion. So lots of sales for this company. It's growing and net profit's growing. So all the things you like to see coming into the public markets. So often we get companies that are not earning a profit, that don't have revenue growth, or that have revenue well under $1 billion. Here we have a $25 billion revenue company going public for the first time since the 1970s. It was public there for a little bit. I see a high quality company that there may be some demand for this IPO, but I can't imagine it's going to be explosive demand. If this is aiming to be a $50 billion IPO, we can't expect this to end up being a $100 billion company the week after, right? And so when you are investing in IPOs, there are all these various risks to consider. And I think this one, if it's priced fairly, if it's priced to the market, if it's priced right, I think there's probably not as much downside risk to a company like this that's profitable and revenue growing than some of the other companies we've seen in the past. Think about Gemini or Beta Technologies. Didn't have a lot of revenue. Navan was still losing money. So here we have a high revenue company, profitable and growing, and a long-term track record of growth. So I think this is really up the alley of institutional investors who are going to want to buy and hold this. And then certainly the index funds. So maybe this company goes public and 6 months later it joins the S&P 500. That could be an opportunity for long-term investors. Or if you're looking for a company that grows at 18% per year for the next 20 years. And investors are also looking for safe havens, and healthcare could be that safe haven when technology stops going up like it's been going up for the past several years. So lots of ways to look at this company, Medline. I'm just happy to see another large company come out of the gates, and hopefully we get a positive reception from the public investors, and that leads us into a healthy and high volume 2026. Timing of this Medline IPO, they're going to need to update their terms either Thursday or Friday of this week. So if you're watching this Saturday, it had to have happened either Thursday or Friday for them to get this thing out before Thanksgiving. If they don't amend their terms either Thursday the 6th or Friday the 7th of November, then we're looking at a December IPO, and every day longer they wait, the more likely it is this thing goes to 2026. When they initially filed this filing. There was a report that said they plan to update the term soon, but if the government opens or if they decide to push it to 2026, we may not see this deal. I'm optimistic that the deal will go through and will end 2025 on a high note. If it doesn't, then maybe it'll be a high note to start off 2026. So watch for that amended S-1 filing that updates the terms. Watch for the retail roadshow. And once those come out, then we should have a pretty good idea of when the final IPO date will be. If it doesn't happen in November before Thanksgiving, then there's still at least 2 weeks in December where they could go out. If the government opens, then technically they might be able to get it out within 8 or 9 days. But even when the government starts working again, we have no idea how fast they could get to this filing and provide comments. Let's move on to IPO Radar news. 3 stories I want to highlight. The first is Ripple. Ripple raised $500 million at a $40 billion valuation. This news came out of a CNBC interview, which I missed. I don't watch CNBC, so when news breaks on television, I don't know what's happening. I'm usually writing or recording a video or editing or doing something, and I don't really pay attention to the television news. I watch Twitter mostly for my news updates and some of the major websites. So I didn't hear this was happening until later in the day. But this is very exciting news for crypto enthusiasts, certainly exciting for XRP holders. XRP, of course, is the digital currency that is native to Ripple. This company has ambitions that it will become a global currency for transactions that lower the cost, similar to a stablecoin. They have their own stablecoin as well. Ripple is looking to modernize the global infrastructure for finance through the blockchain and through their currencies. Their CEO, Brad Garlinghouse, is considered one of the cheerleaders of the crypto world. He fought against the SEC and won. He's an early founder. I think this company goes back to 2012, so a big name in cryptocurrencies. He was on 60 Minutes a few months ago, and that was a big event for XRP and the company itself. This was a $10 to $15 billion company just a few months ago, and so this company is really benefiting from the new administration coming in, overcoming that SEC lawsuit that they were dealing with, which traced back to this XRP being a currency, a cryptocurrency versus a security. This is where the securities regulation is not up to speed with the technology, and SEC still has a lot of work to do in clarifying some of the regulations. This round was led by funds managed by affiliates of Fortress Investment Group, affiliates of Citadel Securities, Pantera Capital, Galaxy Digital, Brevin Howard, and Marshall Wace. They interviewed Monica Long, the president of Ripple, and said this was a record year for growth. They're talking about investors coming on board as strategic partners, more so than investors. They say they don't need the money, but it's going to strengthen their balance sheet. The newsmaker for me in this interview article that came out says here, while other crypto-focused companies such as Circle have gone public, Monica Long, president, says this is not on their radar for Ripple right now. Quote, "We are really pleased to see crypto companies going public. That is great for our overall industry continuing to mature," she said. "We are not focused on an IPO right now. We have the balance sheet, the liquidity to be growing and making moves on M&A and other big strategic partnerships. We will continue to remain private." Ripple was one that I was hoping was going to go an IPO in 2026. This statement by the president and a previous statement by Brad Garlinghouse when he said it was definitely not a priority. They do say sometimes that an IPO is not a priority, and then lo and behold, they come out and there's a confidential filing. But this is a pretty strong statement by the president here that Ripple is going to remain private, at least for 2026. That's how I interpret this. Now, if other companies come out and there's a lot of money going into the IPOs and raising a lot of capital, then Ripple might change their tune. Pretty big jump here, though, to $40 billion in the private markets. I think it would be a little harder for this company to go public at that valuation. So maybe they are better off staying private at this point. What we don't want to see is fintechs taking another beating like they did in 2022, where the values came down. Remember, Chime was a $35 to $45 billion company in 2021, or at least it thought it was. Then it IPO'd a few years later at an $11 to $12 billion valuation. So just because a fintech raises at a $40 billion valuation doesn't mean that's going to hold through any market volatility. So I'm a little skeptical of this valuation here. But remember, they've got this XRP currency, which Ripple holds a big chunk of that, and they're slowly releasing it to the public. And there's not as much scarcity as, say, a Bitcoin. But I know that some Ripple fans are going to be watching this and chime in and comment below, which is great because I want to hear from you people. If you bought Ripple on the pre-IPO platforms more recently, then you have a 4x, 3x, 4x return. So congratulations on that. Doesn't look like we're going to see Ripple IPO in 2026. Let's hope for 2027. Of course, the pipeline needs to stay active and stay healthy, and the stock market needs to stay healthy for that to happen. Now that Circle has gone public, the other cryptocurrency that comes to mind is Tether. Tether is now estimated to be worth about $500 billion. That makes it as large as SpaceX and OpenAI. I haven't written about that yet. It's on my list to write about. Tether is, of course, at the top of the stablecoin industry, which Ripple is trying to get into, but it has this other currency going on as well. So we'll see how these valuations hold. The next story, and I'm hesitant to even talk about this one again, but it needs to come up. Last week, we focused entirely on OpenAI and OpenAI's ambitions to IPO potentially in the second half of 2026. This week, Chief Financial Officer Sarah Friar, who we had got leaks that she was talking about a 2027 IPO, throwing cold water on that whole prospect. Wall Street Journal had some sort of event. In the first paragraph of this article, it says here, OpenAI Chief Financial Officer Sarah Friar said that an IPO is not on the cards in the near term. This is contrary to the reporting we got last week that said that she was thinking about a 2027. Near term, that's a term that, could be next week, it could be next month, it could be next year or two. So we're not sure what that means. Down the article a little bit, it says here, IPO is not in the cards right now. Fryer said, we are continuing to get the company into a state of constantly stepping up into the scale we are at. So I don't want to get wrapped up around an IPO axle. Wall Street Journal formally reported that they were talking about an IPO for 2027. So clearly she's walking back the reporting that came out and that leaked. But in this conversation, she also mentioned this statement about the company hopes the federal government might backstop the financing of future data center deals. And this opened up a new can of worms, because when you hear government backstop for AI, that tells us that OpenAI is too big to fail. And the idea of private profits versus public loss, this sort of backstop statement lit some fire in some people on Twitter, and rightfully so. I mean, this takes us back to the banking system when it was too big to fail and the government had to step in. The taxpayer had to step in to bail them out. OpenAI in this statement is essentially saying, we want the government to backstop these deals, backstop our debt, because we are too big to fail. So how should taxpayers think about that? We can't invest in OpenAI, the private company, or a public company. It's just not investable for most people. Yet the taxpayer is going to backstop their failure if things go sour, and backstop their loans and backstop this industry with our taxpayer dollars. I think we're smarter than that, and that was a really big mistake for them to start talking about that. Sam also mentioned it. Hopefully we quickly get away from that, because I don't think taxpayers have that appetite to backstop this industry. They're the ones making $1 trillion worth of deals. They're doing this with public and private companies, but they are doing it as a private company without retail investors being able to invest. And yeah, there might be some ways to invest through VC funds or tokenization or whatever Robinhood has up their sleeve, but we can't buy into this company. We don't want to backstop this company. If it's going to go private, then you backstop your own deals. Government needs to stay out of it. That said, the government could be open to this kind of thing, because they are partnering with the private sector and they do want to invest in AI and energy. So like I said, I'm hesitant to even bring this up, but it was a big topic last week. Now they're throwing cold water on the IPO. It's probably not going to make the 2026 IPO list. And then this whole backstop thing, I don't think the government's ready for that. I don't think the taxpayer's ready for that, especially when all the wealth is being condensed out in California in the private VC world and the employees of those companies, and not really spreading to the rest of the country. Investors want to see this IPO. They want to invest in this company. Give us this IPO instead of concentrating all the wealth in the private markets and the venture capital world, where people are already wealthy. Last story of the day is another AI darling. It's Anthropic. I've certainly talked about this company before. It is the second largest AI LLM behind OpenAI. It has Claude, which a lot of people say is better for coding in particular. It's better for enterprises. And we've reported on this company that it has hit $3 billion in annualized revenue. It hit that number in May of this year. And then in July, it hit a $4 billion annual revenue pace. So growing extremely quickly. The article that came out this week was from the Information. I'm going to share this TechCrunch article because I can read that one and not the Information one. Anthropic projects $70 billion in revenue by 2028. That's just 3 years from now. Remember, we just learned in July that they're running $4 billion a year in annualized revenue, to go from $4 billion in annual recurring revenue in July of 2025 to $70 billion by, let's say, the end of 2028. That's a 17x increase in revenue. So my first thought when I see these numbers, and we've seen them from OpenAI as well, they're saying 115 billion or something like that over the next few years. And when I first see these numbers, I think, the hubris out there for them to project those kinds of numbers, to say they can actually project that. That's the job of CFOs and in MBAs, to try to project revenue. And you need to do that to satisfy your investors and to try to plan your business. But to say 70 billion, that's really an extraordinary number. And it's also saying 17 billion in cash flow. The growth projections are fueled by rapid adoption of Anthropic's business products. Last month, Reuters reported that Anthropic is projected to more than double and potentially nearly triple its annual revenue run rate next year. And the company is reportedly on track to meet a goal of $9 billion in annual recurring revenue by the end of 2025, has set a target of $20 billion to $26 billion annual recurring revenue by 2026. This is crazy growth. And I guess it's what we should expect because of this extraordinary technology. It's just the numbers are shocking that they're going to grow this fast. And that's just one of them. There's OpenAI, there's XAI, there's Mistral, and there's other startups that are working on this. And certainly Google is out there working on it as well. So when we hear about the AI bubble, there's been several people say that there is an AI bubble. We may think there's an AI bubble, and there may be, there may not be. Well, it turns out, and I think I saw Jeff Bezos said this, there is a industrial bubble, which is similar to the internet bubble, right? That was an industrial bubble because everyone was investing in the internet. And with AI, there's going to be a lot of investment for a long time in this because of this massive potential. And the deep-pocketed companies, the Facebooks and the Microsofts, the Googles, they have this money to spend. NVIDIA certainly is investing their money. They have the money to spend, and if they are spending the money to build out the data centers and the technology and the partnerships, that's going to continue to grow this industry. So whether there's a bubble now or it's forming, or if it's not a bubble, if they can actually realize that much revenue, that's not going to be a bubble, that's for real. So all these projections, I think it's good to be skeptical, but even if Anthropic grows to half of that, like a $35 billion in revenue, that's incredible too. Investors who had a chance to invest in the private markets at the 2 to 3 to 4 billion have seen this extraordinary return on their money. Almost every episode of other podcasts I listen to, they talk about this AI bubble, and the people in the industry are getting that question a lot. Are we in an AI bubble? And the answer, consensus, is yes, but it's got a lot more to grow. It may not pop anytime soon, or it may fizzle. We don't really know, but the real consensus is that AI is the technology of our generation that's going to take us to the future. There's going to be opportunities for other companies to win, and then there's going to be a lot of losers where these high valuations come in and these companies turn into nothing, kind of like what happened in the dot-com bubble and boom and bust. But there's still plenty of internet companies out there, just like there will be these AI companies out there. All we're asking as retail investors is to have a chance to participate. And as long as most of these companies are staying private, we don't have that chance. There are these small opportunities here and there that I talk about in these VC funds. And maybe if you're accredited, you can get some money, 5, 10, 15, 20,000 into an SPV that's investing into these companies. But for the most part, it's not possible to get a pure play investment opportunity. You can invest in the NVIDIAs and the Microsofts and Facebooks and have indirect access to the growth in AI. You could say that retail investors through their index funds have already participated, and that's great, but we would love to see more of these AI companies who are going to benefit over the next decade in the public markets on the sooner side so that we can all participate. And participation means winners and losers, so it's not going to be a straight shot up. I think everyone knows that and we're aware of it. Just when the turnaround comes, how severe that's going to be, we don't know. But if OpenAI and Anthropic keep growing their revenues like they say they're going to, then this is not a bubble and we still have a ways to go. That's all for the show. Don't forget to subscribe to my newsletter. Go to accessipos.com to sign up for that newsletter. I'm going to have a Black Friday deal on our Patreon membership group. So if you want to wait until then to sign up, Patreon, of course, is where we have our private group where we talk about upcoming IPOs and pre-IPO access to these companies with a group of like-minded investors. Keep an eye out for that Black Friday. I call it Black Friday. It's going to be a little longer than Friday, but keep an eye out for that deal. Toward the end of the month, you'll get some free access and discount on signing up. So make sure you're on that newsletter so that you don't miss the deal. Also, subscribe to my YouTube channel, subscribe to the podcast, follow, like wherever you consume your podcast. Thanks for watching, thanks for listening, and I'll see you next week. This video is not a recommendation to buy or sell any startups mentioned. Pre-IPO and IPO investing involves significant risk. Conduct due diligence by reading the SEC S-1 filings before participating in IPOs. Do not invest in IPOs with money you cannot afford to lose. Thanks for watching.